Here we go. Sorry, if you are now live. I'm Mark Gomes, PTT Research. Welcome to our Q&A session. Today we are doing something a little bit special and opening it up to the public. So for those of you who are not familiar with our format, you should have a Q&A button on your dashboard. Ask questions. I think there is a means to upvote questions that you already see. The questions that have the most votes are the ones that will probably get answered first, and certainly the smartest ones will be answered first as well. So just to kick things off while the Q&A queue is getting started, I'm just going to give you a little background on some of the things that have been going on here over the last few months, and indeed the last several days. Of course, the big story is over the last few months since Q3 earnings season, we experienced a significant downdraft in the value of our stock picks, and that during this time period, I've been pretty adamant about the fact that there's been no change in the actual fundamental condition of the companies underlying those stocks. Now, this is an important distinction for all investors to learn and understand, and that a stock is what value. Okay, so if you are invested in a stock, then you have to be mindful of the value of the company underlying that stock and how that company is performing. If the company is performing by up to the expectation you have for the company, and you have gotten a good evaluation analysis of what the stock should be priced at for that fundamental reality, if nothing changes in that fundamental reality, then nothing should change in the value of the stock, or at very least the stock should be gradually rising to reward you for being invested in that company. Okay, when that doesn't occur, we call that a fundamental technical divergence. It's the divergence, the split between the fundamentals of the company and the movement of the stock price, which is usually driven by technical analysis these days, which in itself is flawed because it is not led by the fundamentals of the company, which is ultimately what decides the value of the company shall be. Over the last several months, of course, most of our picks were down significantly. Sorry for the adjustments here. Over the last few months, despite no change in the fundamental condition of the companies, I was very happy with the Q3 earnings reports out of each of our 5 major picks: QAD, GLUU Mobile, JAKK Specific, MATR, and AERO QADA. And now as we enter Q4 earnings season, this is the first chance these companies have really had to come out and say, here's how we've been doing, and you can judge for yourself what our stock price should be based on our latest update. And thus far, we have seen last week, GLUU Mobile came out with remarkable results and announced Katy Perry as a new signee to their Stardom line of games. This is exactly what we've expected. This is exactly what the company said that they would do, is take the success from Kim Kardashian. And look, not for nothing, if I'm any star out there and I see how much money Kim Kardashian made off of this video game, I want a video game too, right? And who are you going to have as Kim's? So that's up and talking to them, so they have a pipeline choices to decide who they want to do this with next. And obviously they can't do it with everybody at once. They can scale this up over time, I'm sure, but announcing Katy Perry should have come as no surprise to anybody, and their fundamental success should have come as no surprise to anybody, because they have made every quarter probably since 2008 from an EPS perspective. Okay, so that's an example of some of the things we've seen over the last week. Scott's Miracle-Gro announced their earnings, and in the midst of it, the CEO announced that they're interested in acquisitions, and the description of what they'd be interested in was an identical match to their close partner AERO QADA. And then, of course, last night MATR announced earnings, and I thought that was a great lesson in stock analysis, because in most cases, right, the average investor takes a look at two things when an earnings announcement comes out: revenue versus street expectations, and EPS versus street expectations. Okay, that's very myopic in my opinion, because a company, not just the revenue they produce, and it's not just the profits they produce. There's a lot more that goes in to a company, and indeed, a company at its onset has no revenues and zero profits, and ramp up to the point where it can produce profits. So in the case of a MATR site, where you see the new product taking the reins, and most of the demand for MATR site solutions are for the new product, this is essentially a new company. And what you see is they are responding to the demand by hiring folks to address the demand that they're seeing in the marketplace and to deploy these solutions as the customers purchase them. Okay, that requires an investment, and those investments are sure to pay off based on the demand that we see in the marketplace. The more people they get in front of, the more people that will buy the solution, the more money they'll make, right? But first, you have to hire people to get in front of those customers. And what does that do? It increases expenses, which decreases EPS, and that's why they miss their EPS numbers, okay? That was all described in my report today, so you should check that out for the details. But the point of the matter is that you see that an EPS miss is not necessarily a bad thing, particularly in a case when it is done to invest in faster growth in the future. And a similar case goes for when you are looking at secondary public offerings. When a company goes out and does secondary offering, the immediate reaction by the investing public, of course, is to sell the stock off. I understand that. That's in my opinion, it's a short-term supply-demand imbalance, right? There's going to be a large supply of shares in the market, and therefore the share price decreases in reaction to that. In my opinion, in those cases, depending on the reason for the secondary offering, that is what should determine whether the stock goes up or down. Because if the reason is to accelerate the growth of the business, then the demand for shares in that company should increase to match the supply that is coming on board. And so we see cases like we saw with Attunity and more recently with QAD, where after the offering takes place, the share price lifts up. And in the case of Attunity, they did see great fundamental progress that eventually led to the stock tripling in value. Okay, so those are some of the things that you have to look at as a professional investor. Again, I've been doing this for about 20 years and focused on the technology industry and the nuances of growing a technology company. So hopefully that gives you a little bit of a flavor for the things that I look at beyond the Wall Street estimates on revenue and EPS. It's important to get on those earnings calls and pay attention to what the management team is saying about the business and the future direction of those businesses. Okay, enough chat for me. Let's get back to you folks and see what kind of questions we have here. Give me one moment while we queue it up. And let's see. Here we go. First question. I'm new to shorting, and at this point I feel more comfortable in building hedges by buying ETFs such as RWM, the short Russell 2000. What are your thoughts on this approach? Any cons to actually doing traditional shorting? That's a great question. I love that that lead-off question. First of all, I like that you're not using an ultra short fund. Okay, there's one reason why that is not a good idea, and it's called contango. C-O-N-T-A-N-G-O. If you don't know what it means, look it up. I'm not going to spend time on that here, but it is the reason why these ultra short funds and ultra funds in general don't outperform the market over time, which means that your timing has to be precise. And in my estimation, there is nobody that over time can get the timing precise on a consistent basis. If they did, then you would see more multi-billionaires that are traders, and we don't see that. Who are the world's richest men? Investors and investors. Two different types of investors. One type is Warren Buffett, right? He's a long-term investor. He buys into a company, he stays in it for a really long time. No timing involved. Richest man in the world, okay? The other type of investor is somebody like Bill Gates, who became the richest man in the world for a bit because of his long-term investment in the growth of Microsoft Corporation, okay? Those are investments. You don't see traders at the top of that richest persons in the world list. It's usually CEOs and long-term investors. So that being said, so that's the reason why you can't use those double shorts. An RWM is good because it is not a double short fund. It's a simple short. There's nothing wrong with using those. But to answer the second part of your question, don't be afraid of shorting stocks, because when you buy RWM, you are shorting stocks. RWM shorts the Russell 2000, which means it automatically shorts every single one of the 2,000 stocks in the Russell 2000. So you're not only shorting, you're shorting 2,000 companies. And you're not even being selective about it because it's, so you're getting the full complement of companies in that index. My preference is to go through those companies, and why don't we select out the 1,000 worst ones, right? And only short those as a basket, or narrow it down to the worst 100, or narrow it down to the worst 10. And that's sort of what we do here at PTT Research. We take a basket of companies that we're familiar with and dig deep into each one of them to figure out which ones are the very best and which ones are the very worst. And mainly for our PTT pipeline newsletter subscribers, on a weekly basis, we're usually talking about a different company. We probably talked about 100 different companies last year if you include the 50 pot stocks, marijuana stocks that we looked at, and provide short ideas to offset the risk of the stock market going down in value. Now, as you all know, I have a yellow alert out there right now. That yellow alert has not been working very well. It did for the first week or so. The market was down about 4% in the first week after I initiated that yellow alert. Look, if I could go back in time and not issue that yellow alert, I'd still do it. And the reason for that is that the market is at elevated risk. Regardless of whether the market goes up or down over the next day, week, or month, the risk is elevated in my opinion, and therefore I want to be safe. That approach is what has made for successful investing over the last 20 years that I've been doing it. And so if you're following my methodology, that's the way we want to do it. So Charles, thank you for the great question, but don't be afraid of shorting stocks. If you are shorting that are fundamentally flawed, if you look at a Magic Jack several months ago, look, everybody's using smartphones now. Nobody's using a Magic Jack or Skype or something like that. Magic Jack is losing its relevance in society. So that was a company that I felt was, fundamentally impaired a while back, and that stock has done nothing but go down. It's been profitable for short sellers. If it wasn't, it's just a hedge to protect you against the market decline. Because if the market went down, then Magic Jack would go down regardless of whether the business was still doing okay or not. But it gave you a bonus. It paid you to have that insurance policy against the market. Profitable insurance is what I call that. So just be focused on fundamentally flawed companies. Jack, like a leapfrog a year ago when tablets got passed down from parents to children, they didn't need to buy a leapfrog for their children. They just needed to give them some apps on that old tablet they weren't using anymore. What did that do to leapfrog? It killed them, and it killed the stock. Plenty of examples out there. always will be. Okay, so don't be afraid to short. I don't see any downside to shorting as long as you're picking terrible companies. All right. Here we go. This one comes from Matt Demansky from the PTT Elite Service. They kept me relatively calm and focused during the recent downturn on your picks. Now that you've been proven correct, are there going to be any future videos for us to learn from? We at PTT Research are always evaluating what kind of services we should be providing to investors, being mindful of the expenses that we take on here. The PTT Elite videos that we provided to you folks through the back half of last year were our gift to our early subscribers as basically a part of our anniversary of being in business. So at this time, to the PTT Elite service will remain part of PTT Elite, but as you see right here, we are doing a Q&A session, and that's a value add. That's not part of the newsletter that that you are subscribed to and paid for, and we're going to continue to do things like that to try to add value. And some of those things might be premium services, and some of those things will be free, as this Q&A session is tonight. Matt, thank you very much. Let's move on to our next question. Here we go. With my picks showing good quarterly reports, but the market having a yellow alert, should we be prepared for these 30% gains to disappear in the near future? Possible buying opportunities. Okay, so that question kind of speaks to near-term movement, and I issue yellow alerts when I see the market at an elevated risk level. That doesn't mean that I'm necessarily going to be right, and I'm certainly not trying to time the market per se. I'm looking at from a fundamental perspective. What are the valuations looking at this point in time relative to what we're seeing out there? And my yellow alert is predicated on the fact that we've seen stock prices continue to rise, despite the fact that earnings announcements for the most part in Q4 were worse than what we've seen in recent. Twice as many companies disappointed. In addition, we're seeing several markets undergo turmoil. The oil market, of course, in turmoil. Commodities have gotten hit. We saw a very spotty record amongst the real estate companies. And if you've read some of my research on this, my interpretation is that quantitative easing is actually giving us the risk of deflation, which is very counterintuitive, right? How does printing money, which is the very definition of inflation, create deflation? Well, here's how. Quite simply, quantitative easing has made the cost of borrowing lower, okay? And if you look at who the primary beneficiaries are, who the takers are of that money, it's been corporations. You see corporate profit margins have reached all-time highs, and let's say that they're somewhere around 10%. And let's say that you can borrow money for 5%. That means you could take that 5% money, invest it into your business, which is garnering 10% profits, and you pocket 5%. Why wouldn't you do that? You do that all day long. So as a result, companies like frackers in the United States were given an opportunity to borrow money at lower and lower rates while oil prices remained stable and high. So the lower those interest rates came, it got to a certain point where they said, hey, at this point, if I borrow money, I'll break even on this fracking project. But as interest rates continue to lower by the quantitative easing policies going on, you had a profit now, right? So the frackers started, you said, more oil production. You had an increase in the supply of oil as a direct result of the easier lending environment. But the easier lending environment did not increase the other important component of commerce, which is demand. We had an increase in supply, but not an increase in demand, right? There may have been an increase in speculation, right? So if you could borrow money at a cheap rate and speculate on the price of oil, that could keep the price of oil high, as we've seen in the real estate market, which may be the next marker, by the way. and that keeps the prices high. But as the supply continues to increase, eventually it overwhelms the speculation. And what happens at that point is the price starts to decline. When the price starts to decline, speculators get out of town, as we've all seen. Out of town, then the prices of the product can plummet, like we've seen in oil, very dramatically in a very short period of time. And that is because there is no fundamental increase in supply, in demand, the true demand for oil. In fact, it's pulled back a little bit in recent months. These are the sorts of things we have to be careful of. This is why I've got a yellow alert on the stock market, okay? But it's specific to the stock market. I still love our companies. And as you've seen over the last week, that love for those companies and what they're doing paid off handsomely in to the tune of 50% increases in the value of AERO and MATR over the last week, and probably a 35% increase in the value of GLUU Mobile over the last week, to reset those valuations to basically where they were prior to all the selling that took place. So to answer your question, are we going to see a pullback in the share price of the companies that I'm following? I don't know. All I know is that I love the valuations of these companies. I can't predict near-term movement. The methodology provides some risk-reward guidelines to help you, own a little bit more or a little bit less of our companies at high risk or low risk points in time. Okay, but the main thing that we do here is evaluate what we think the company is worth. Okay, so if I think MATR is worth $10 today, that is not the same as predicting that it's going to be priced at $10 tomorrow. The rest of the public needs to agree with that for that to happen. And certainly if the stock market goes down in value, then MATR can go down in value also. The difference is that I don't think that the stock market is undervalued. I think it's overvalued. And I don't think that MATR is overvalued. I think it's undervalued. The proper course of action is to own MATR and wait until it reaches a fair value, and to short the market and wait until it drops to a fair value, and hopefully we make money on both. Now, what's happened so far since the beginning of the yellow alert, right, is that the market has not gone down in value to make us money. It has actually gone up in value slightly, ever so slightly, to lose us a little bit of money. Meanwhile, our stock picks have gone through the roof, and we've made a ton of money on that side. So the little bit of loss that we made here has been completely overshadowed multi-year, and we've done so safely, without fear of a market decline. Because if the market declined and our stocks declined, well, we'd be making money on the stock market as it went down and losing money on our stocks as they went down, but those would offset the gains, and we protected from action while still being invested in company results. As you've seen over the last week or so, that has worked out very well in our favor. So again, the yellow alert has allowed me to sleep well at night, and it hasn't taken a lot of money out of my pocket relative to what would have happened if I hadn't called it. It's safe investing, okay? We have a question here that pertains to a stock that we haven't issued to the public yet. So you who provided that question, the ticker symbol starts with a D, answering that question. So just FYI, don't feel bad. I'll be deleting that. Those of you who would like to know what that stock is, sorry, but you got to subscribe to the service. Let's see. Here we go. Okay, in last week I said that those not already invested in QADA should position. Given QADA is now up 10% for my initiation, what is your price target for QADA? Is the risk reward still favorable if it's not tripling from here? Okay, that's a good question. Now, certainly the impetus for the QAD interest was, they did the secondary offering. The secondary offering sent the stock plummeting, I think, into the 17s. That's about $140 million of maintenance revenue. Effectively an insurance policy for the customers of QAD software to ensure that they get software and that the software doesn't break and things of that nature. It's maintenance. Okay. 104 worth of maintenance costs next forward. And QAD's been around for 20 years. The software works. It's been proven to work for as long as I've been around. So what I'm doing is taking that maintenance revenue, and these are pretty much covers their butts. No IT manager wants something crazy does happen to QAD software, and it breaks down, and it ruins the business or what have you. Who's going to be to blame if they don't have the fallback, if they don't have that throat to choke? Okay, so $40 million a year that QAD for something that's inherently stable, and that traditionally is worth 2x from a valuation perspective because of the amount of money that it pulls in from a profit of 2x. I would easily argue for 4x on 20 years with that maintenance basis, and the interest rate environment is so unfavorable. Interest rates are so low, premium now. So if I was a private equity firm with a couple $1 billion to invest, and I could have $560 million, I would do it in a heartbeat. Okay, and then I would get everything else that the business has to offer for free, which is the cloud business that's growing. It's on I believe a $30 million run rate, growing at 50% a year. A company like that, if that went public today, would trade for at least $150 million, if not more. So you can tack that onto the value. They have a headquarters. You can go on Zillow and look up on a map their headquarters and see QAD's headquarters looks like this, and all the houses around it look like this, and all those houses are worth well in excess of $1 million. They have a tremendous piece of property on a cliff in Santa Barbara that is actually on their balance sheet declining in value because of the rules of accounting. And so yeah, as I've said before, the funny of a company and some of the things that are going on, the rules of revenue recognition do the same, as we saw with MATR site last night, made the company look not as good as we are, and we found out on the conference call things are going great. So these are the sorts of things that I looked at in QAD. I've known this company for almost as long as I've been in the business, about 20 years. Love it. It's a very good company. If they announce a bad quarter here and there, I don't worry about it. There's tremendous value in QAD, and they haven't re-reached their 52-week high in the wake of the secondary offering, and that's why I said last week that the risk reward looked pretty good there. You can draw your own charts based on what is listed in the methodology section of poisedtriple.com, and hopefully that'll help you out, and maybe we'll post some charts in the subscriber newsletters in the coming weeks. Similar to last, actually on the same topic, what do I make of the 2 million shares of insider selling for QAD? Okay, so QAD did a secondary offering, and part of that secondary offering, I don't know if it was 1 million or 2 million, kind of irrelevant to the question. The point is that the Lopkers, Pam and Carl, who started this company, a little known fact, Carl Lopker also was a founder of Deckers, Ugg boots. Very successful guy, knows how to run a business. They took some money off the table there. Is there something to be concerned about in that regard? I don't think so. I mean, look, if you were an executive and you started a company from scratch and it grew to be worth hundreds of millions of dollars, and 90+% of your wealth was tied up in that company, the prudent thing to do would be to diversify your wealth and sell some of that company. effectively, Pam and Carl Lopker have a portfolio. And if you look at the PTT portfolio, most of our stocks have 10% QAD, 10% in GLUU, 7% in MATR site, what have you. You can look that up for the exact numbers, but you notice that those numbers are small. We've spread our money out across many companies with no more than 10% allocation to any company. They have 90% allocation to one company. I have no problem with executives taking some money off the table. And this is why when you see insider selling, listen to this carefully right now, folks. Listen to this very carefully. When you see insider selling, when you see an article on Seeking Alpha talking about insider selling in any company, I don't care if it's mine or anybody else's, throw it out, okay? There are many reasons executives might sell shares in a company, and it's not in and of itself a sign that you should be selling the company's stock, okay? Rather, I would rather do research on the company and determine for myself whether the prospects of that company are good or bad and judge the stock based on that, not whether or not an insider is selling. There's a million reasons why insiders sell. Diversifying their wealth, like the Lopkers. In the case of GLUU Mobile, there was an executive there that had personal reasons for needing to sell. We see that all the time, okay? And it's no reason for concern, okay? It's almost a waste of my time that could be used talking about insider selling. To me, if you write an article about insider selling without providing the fundamental details of what's wrong with the company itself, you either don't know what you're talking about or you're intentionally trying to scare people, okay? What are my thoughts on the valuation if GLUU were to be acquired? I didn't get a chance to look at King Digital's earnings announcement. It was obviously quite good. The stock was up tremendously, and that is, in my opinion, a very positive sign for the entire industry. You saw GLUU's numbers were much higher than I expected. King's numbers higher than expected. To me, that's probably a sign that, one, the installed base of smartphones is expanding rapidly. Two, the utilization of those smartphones to play video games is expanding rapidly. And three, the willingness of users to actually pay money to play those expanding rapidly. This has been a trend for a long time in Asia, where Japanese video game players will routinely, for their free games, end up investing hundreds of dollars in various to enhance their position in those games. That was not a trend in the United States. That really kind of came into its own until just last year. So we're still in early innings of Americans getting used to the idea of paying money to continue playing their games. Oh, really true. Because we used to pay for our games all the time. They were called arcade games, pump quarters into the arcade games. And I remember back in the 80s when I was in college, taking a roll of quarters to the arcade and pumping $10 into the machine as a college kid that didn't have much money. So what's the difference between then and putting $10 into playing one of GLUU Mobile's games or one of King Digital's games? None, except $10 nowadays is worth a lot less than it was back then. So maybe we're talking $20 or $30 that should be put in. So I think as Americans get used to paying a little bit of money to play their game, this trend continue where the increased number of people with smartphones who get used to the idea of playing games on the smartphones, who get used to the idea of paying for those games to the smartphones, are going to translate into higher revenues for the companies that have established themselves as putting out good video games, Digital and GLUU Mobile. And I know, at the IPO, I was a detractor of King Digital. I think, longer term, I still have some questions. I wouldn't be an investor in King Digital because they have all their eggs and Candy Crush clone basket, and people kind of get sick of playing those types of games, and eventually they will. Then they have to have something else to fall back on. GLUU I like in particular because they have a large swath of games. They've got the sports game and the baseball. They've got the racing game with the cars. They've got the Kim Kardashian type game. They got the Diner Dash. They cater to children and adults. They cater to men and women. They've got a nice portfolio of games and engines, software engines that they can use to make additional games at a cheaper cost. It does make them very attractive as an acquisition candidate. They've got some great assets. Most, not most notably, a good management team that doesn't miss their EPS estimates. They make great acquisitions. They're very good at acquiring companies, which is very valuable in a market where we have thousands of video game developers. In fact, yes, you could learn how to build a video game and put it in the Apple Store and sell your video game. Even though you don't know anything about coding today, you could learn. Would it be successful? Absolutely not, right? But if you made a killer game and didn't know how to sell it and didn't know how to get your game known by the masses, and GLUU Mobile happened to see this game and thought that you were onto something, they'll acquire you for something that you would think is attractive, let's say $2 million, right? And they would take that game and plug it into their system, and their system would be able to take that $2 million worth of value that they provided to you into 20 or more million dollars. And that's the Kim Kardashian game. They bought that company for, say, $20 million, and they'll probably pull $100 million in revenue from Kim Kardashian alone, and who knows how much they'll get from Katy Perry and the stars that come thereafter. Okay, so there's tremendous value in GLUU Mobile. It's long-term value right away. The ability to acquire companies, the ability to make, and the name that they, as a company that has made several video games that have been successful, Deer Hunter, Kim Kardashian, their name is out there now. And an app store, and you see that little GLUU Mobile game in the corner of the icon of the game choices that you have, you know that it's a GLUU game. You know there's a good chance that it's a pretty good game because they make pretty good games. So if you're an acquirer, there's absolutely value there. My price target on GLUU Mobile is about $10 a share. If I was an acquirer, if I was a company like King, $10 a share for GLUU Mobile tomorrow, absolutely. Okay, next question. Starting to be a real believer in your abilities. Yeah, this week has helped, right? Thank you. One concern is if I end PTT, you would not know how to pick stocks. How do you teach yourself how to, and if I plan on being with PTT for the long term? Look, I love helping people out. This is fun, once a week, get in front of you folks, answering questions. I don't know how many people are on this broadcast. Yes, I do. It's right there in the corner. And I don't know how many will see the replay later and the transcript that we put out. But there's a good feeling that I get when I see somebody like you, Amit, providing me with thanks and letting me know that I'm helping you learn how to become a better investor and make money. It's a good way of giving back for what I've been blessed with. And so, as long as it's fun, I'll keep doing it. Sometimes it's not fun. But when it's not fun, I usually just go away, because when it's not fun, it's because people are making noise that doesn't make sense, just like they did over the last few months. You can't fight against that noise. When people don't believe in you, the last thing you need to do is say, believe in me, because that makes them believe in you less. It's just a vicious cycle, and we've started to see that come back this week, where GLUU Mobile's report gave people confidence to start buying into our other picks, and the news for AERO gave them even more confidence, and we saw MATR stock rise before the news that they pre-announced on Monday, and then continue to go up from there. And we're seeing JAKK Specific and QAD go up as well, even though their news hasn't come out yet. So that's a virtuous cycle where belief creates belief, and mistrust creates mistrust. That's the human nature. People tend to go with whatever the trend is. So what you'll find is when human beings as a whole determine that they want to be mistrustful of what we're doing here at PTT, all I can do is go away and let them be mistrustful. And when the tide turns and when the fundamentals show what reality really is, and that trust comes back, and that positive emotion is in the air and people are receptive to what we're doing, then the time comes to come back and say, okay, you're ready to hear what we have to say? Here we go. So, as long as that happens, I see myself stopping this anytime in the near future. So don't worry about that. But to answer the first part of your question, how do you learn to be a good stock analyst? Oh, goodness. It really took, 10 or 15 years for me, going to college, first of all, getting a finance degree will help. There's certainly books out there to teach you the fundamentals of stock investing. You need to learn how to statement. And don't tell me that you know how to read an income statement. If you're asking this question, and I'm not talking to you specifically, I'm talking about to the entire audience, okay? If this question is of interest to you, you probably don't really know how to read an income statement top to bottom. And what I mean is not understanding just what the headers mean and looking at the numbers, but what are those numbers saying about the story? Because a company is made of products and services and people that want to purchase those products and services. Apple wouldn't be a $700 billion cap company if they didn't have products that lead to that market capitalization. Okay? You have to be able, so when I say read financial statements, I mean understand what they're telling you. An income statement, a balance sheet, a cash flow statement, SEC documents like 10Ks and 10Qs. You want to get on earnings calls, or at least read the transcripts. And the key to PTT, the secret sauce here, is that we understand the industries that we're working in. You'll notice that most of the companies that we are selecting for you folks fit into one of two buckets. They are either in technology or they're dealing with consumer trends. Okay? Because everybody at PTT Research and everybody out there is a consumer. Okay? The advantage that we have here is that we utilize resources and we have meetings and we talk about things that we're seeing out there in the marketplace. Uber, right? Kind of a big story that's come up here. That's something that we talked about a little while back here at PTT, and we can start to identify what a new thing, what kind of impact that's going to have on the rest of society. So when you saw Amazon came in, right? What orders a bookstore? Detrimental for business. When the iPad came along, what impact would that have on the leapfrog? Detrimental for business. Things like that, right? So those are the sorts of things that you can do. What CNBC is saying. You want to catch on to these things before it becomes big news on CNBC. I hear the word Uber on CNBC every day now, okay? So it's well known. But before it was well known, you had friends and family members using this service for the first time and saying, wow, I'm going to use that more often and I'm going to tell everybody about this because this really kicks butt. And at that moment, when you realize that something might become big, that's when you can start taking advantage of it in the markets. Okay, so that's one thing you can do to become a stock investor. The other, from the technology standpoint, we utilize experts in the field. Okay, we allocate 6 figures annually of the subscription revenue that you provide to us. We're investing that in research. We're going out to people who understand technology sectors. I don't understand behavioral analytics, which is what MATR does. I don't understand it at all. Why would I? I didn't go to college for behavioral analytics, right? So what do I do? Go to one of the best organizations on the planet, Harvard University, find the expert on behavioral analytics, and see if we can pay somebody there to take a look at what MATR doing and let us know if this is the real deal. And that's the sort of thing that we do. You can do that too. It's a little prohibitive from a cost. You have friends and family, and as you build your network over time of friends, family, and acquaintances, each one of them has an expertise. There's something that you do for a living. There's something that you do well. That makes you an expert at that. And if you share that expertise with somebody else, that will help them understand the industry that you're working in. And you can get that same knowledge from other folks with what they do. Okay, so that gives you a little bit of sense of what you can do to start developing your own skills as an investor. Okay. Okay, this one comes from Robert Schwartz. Mark, I am trying to utilize your methodology in my stock evaluation. I am roughly 5 years from retirement, congratulations, and would like to take advantage of shorting stocks. Since my accounts are largely IRAs, what can I do? Okay, so to short individual stocks, you're going to have retirement accounts don't allow you to do that. Retirement accounts will enable you via ETFs like RWM, being the Russell 2000 short ETF, or HDGE hedge, which is the Prudent Bear Fund, which actually shorts stocks in their fund. You can purchase those securities, which move up in value when the securities in those ETFs go down in value. They're short funds. So for retirement accounts, those are your main choices. I personally use HDGE in my retirement accounts. RWM is a good choice as well that I'll probably utilize a little bit more going forward in my retirement accounts. The only other thing that you can do is maybe set aside some money and have an individual account, a non-retirement account, where you can short individual stocks. But unfortunately, the way that the system works today, that is really your only option. Okay, I hope that helps. This question comes from Dan Potter. Mark, do you find that when you post your updated research and data on your PTT stocks and it's positive, do you see the stock jumping, whether positive direction or if it was a good update or vice versa? Yeah, I mean, obviously, it's hard to say that that's not the case. Clearly, I think there's a couple of circumstances that come in here to play here. One is when I put out a new selection, right? Generally speaking, we've done a great deal of research. Again, we have a six-figure budget, and we deal with smaller companies that Wall Street firms generally don't traffic in. So as a result, we find a very sweet spots in the middle of the market, right, where you've got these companies that are too small for the professionals to invest their money in. So, professionals have huge budgets. Goldman Sachs could put millions of dollars into researching MATR if they wanted to. We can't. We don't have millions of dollars to spend on a single company's research, right? They could beat us at that game, but they don't care to because the company's too small. Now, on the other side of the equation, the people who care about MATR, the moms and pops, folks like you out there, generally can't afford to spend 5 figures researching MATR, so you don't. So as a result, what happens is the small guy doesn't understand the company, the big guy doesn't understand the company, and that provides an opportunity for us sitting in the middle and say, hey, if we put this a little bit of a budget into researching this company, we can understand what is true. And sometimes what you don't see behind the scenes, right, is we look at 100 just to narrow it down to 10 that we're going to dive deep into, just to narrow it down to maybe 3 companies that will actually put some significant resources behind, like a MATR and put that heavy dollar investment in. If we put $10,000 into researching 3 stocks and find 1 to triple out of those 3, and remember, starting from 100, right, then we've effectively spent 30 grand and obviously a bunch of hours, but 30,000 in cash to find a stock that can triple in value. Put $100,000 into that stock and it goes up to 300,000. You've made a $30,000 investment. You subscribers like you are providing us with subscription fees. That $30,000, is taken away by those subscription fees, and so we as a group get to benefit from this sweet spot in the middle, where in general, if it was just me or just you, we wouldn't be able to do it. And obviously, again, Goldman Sachs doesn't care to. So as a result, getting back to your question, right, when we put out a piece of research, it is generally something that nobody has seen before, about a company that people previously didn't realize has tremendous potential, right? And as a result, it's almost inevitable that people are going to buy that stock. So yes, the short answer to your question is, when we put out a piece of research, generally speaking, we are going to be speaking about something that people don't understand. I'm not going to talk about companies or situations that everybody already knows about. I'm not going to tell you. I'm not going to put out a 5-page report on Apple being a good company. Everybody knows that Apple's a good company. So it's kind of, you know, a case of the chair there. So, and but I'm always happy to answer these tough questions, right? I want you to understand. I want you to ask tough questions. I want you to, you know, even back me up against the wall. There's absolute clarity here at PTT Research. What's really important here, you know, when we started this company, and when I started even beforehand as a blogger, the problem that I had with the internet and the advent of social networking is that it made it so much easier for bad guys to come in and fool people and trick them into thinking that stocks are something they're not. It's really easy, amazingly simple for me to start putting out pick to triple reports about any company under the sun and just make up the research. How do you know any better, right? And so that's unfortunate. There's a lot of those bad guys out there, and so one thing that I've made sure is to make sure that I'm a very public entity. You know, everything about my life is out there on the internet. You can, you know, see my past career from International Data Corporation to AMR to Pipeline Data to PTT Research. You can see my career as a track and field athlete. You could even come and take my track and provide free for the public on Miami Beach on Monday nights. That is so you know you're dealing with somebody with integrity and has nowhere to hide if you know, if a fraud gets perpetrated, right? I'm out here in the open. So please ask those questions if you have concerns, if you have doubts, because those fears and doubts need to be eliminated for you to be a good investor. If you're going to buy our picks, you need to trust in me and us. Has to be. Otherwise, it does no good to you, because the second the stock starts going down, you're going to wonder, is it because Mark Ohms is a fraud, or is it something that I should go and buy more of this stock? If you don't have the answer, you're probably going to opt to sell out. And those who did, and I feel bad for them, some of them sold out a MATR site just 1 month ago at less than $5 a share, and the stock was over $7 today. That's a 40% gain that they missed out on in 1 month because of fear. And that's unfortunate, okay? And that's it's a really bad byproduct of the bad guys in this world. So, you know, be sure to vet the people that you are paying attention to. Make sure that they're people that you can trust. And, you know, if they're hiding behind anonymity or aren't willing to put themselves out there, just pass, right? If you don't know what you're dealing with, don't deal with it. Don't worry about missing out on something. That's a bad emotion as much as fear is, okay? You have to deal in an emotional state. The stock market is best suited for people with the mentality of Mr. Spock or Warren Buffett. Same thing, basically. Okay, let's see here. Any chance we could get an updated portfolio tracker with a mock portfolio based on suggested weights? It will not be exact, but I think it'll help new members stick to your rules. You know, I certainly, for you know, PTT Elite members get access to my model portfolio, including all of my longs and all of my shorts. And I think I've made it public today that Apple has been one of those long ideas that the PTT Elite members have made some good money on of late. Just as an example, as far as our traditional members and our traditional methodology, it's very simple. The rules are out there. QAD being a value stock is a 10% position. GLUU is a core position, is a 10% position. You know, JAKK and MATR are both momentum picks, I believe, and those are 7% positions by the rules of the methodology. AERO is a speculative position, and that's a 1% position based on the methodology. So if you read the methodology, often, I read it basically every month. I wrote the thing and I read it almost monthly. Why? Because I need to be reminded. It's a 30-page document. Nobody, well, I certainly can't memorize 30 pages worth of rules, but the stock market is complex. So you have to do that. You want to be a good investor, you have to read the methodology often, stick to the rules, And as it pertains to risk reward, to help you with the weighting, right? Just some guidelines I'll give you, but this is in the methodology as well, and maybe we'll add some of the details of this. If you have your long-term risk reward channel, those of you who don't understand what that is, you have to read the methodology. Those of you who read the methodology certainly know what a long-term risk reward channel is, and that's the primary thing that we judge a stock by, because that is the physical representation of what I think the value of the company is if things go right versus things go wrong, and the growth trajectory that we expect to see out of them over time. Okay, it's very commonsensical at the end of the day. Now, within a long-term channel, which looks like this, with ups and downs in between, there are those ups and downs. So you see these little channels form ups and downs in the midst of a long-term trend. You all know what I'm talking about. Stocks go up and down over time, but those short-term ups and downs are nature, not fundamental in nature. So, but because people pay attention to technicals, here's what we do. Okay, when I pick a stock, you want to buy it right away, no matter where it is in the risk-reward channel, because value stock. Okay, so no matter where a stock is in its risk-reward channel, if I find a stock that I think should triple in value over the next 2 to 3 years, I'm buying it right then. Okay, from there, if we have a short-term channel and it reaches the top of the channel, I will usually use that as an opportunity to trim back my profits, take the profits off the table, and get back to the original position. So if I purchase a 10% position in a stock, it rises 20% before it hits the top of a short-term channel, then I will have made a 20% profit. I will take that profit off the table, and that will bring me back down to a 10% position. Similarly, if it drops down to the bottom of that short-term channel, from that 10% position that I reset myself to at the top of the channel, and the stock pulls back, let's say 20%, I now have a smaller position, and I have to buy back that 20% to get back to a full 10% position, and so on and so forth. And what ends up happening as a result of that is you are buying low and selling high. Voila, right? Now, that doesn't guarantee that the stock's going to go up or down at those exact moments, okay? At the top of a risk-reward channel, the stock could get acquired the next day, okay, within the short-term ups and downs. This is why we want to pay more attention to the long term. The long term is fundamentally based. The short-term stuff is all technical. So the technical stuff is kind of, we're fooling around, we're trading, right? Selling a little bit, buying a little bit, trying to take a little bit of profit here, and maybe building back the position at opportune moments. But sometimes those channels will break down. That only makes the stock more attractive. Okay, we saw that happen with MATR last month. Okay, the short-term risk-reward channel was breached to the downside. That wasn't a signal to sell. It was just a signal that the stock was getting even cheaper. Okay, risk-reward lines are just guidelines. They're not fixed in stone. The reason why a technical analyst is not the richest person in the world is because technical analysis doesn't work enough of the time to make somebody the richest man in the world. It's just a guideline. Okay, what's important is the value of the company, and if the value of the company remains intact, you take a GLUU Mobile or a JAKK Specific or a MATR site, all of them, in my opinion, good progress in their businesses in Q3. Their stock prices come down in value while that fundamental progress remains intact, and there was no reason to believe that it wasn't, based on their Q3 results, then the obvious conclusion is that the stock has become more attractive. And we are only using the risk-reward lines as guidelines to help figure out whether or not it's time to take some profits or add to the position. Okay, so read the methodology, learn these things for yourself. I can't do this sort of stuff for you because there's just so much movement in the markets. Okay, my job is to pick stocks. Once a week, I spend an hour with you folks. The rest of the time, I'm looking for the next stock. I'm looking through these 100 companies and trying to find that one to find that QAD, to find that GLUU Mobile, to find that JAKK specific, to find that MATR site, to find that AERO. Only 5 companies that I've found over the last, 12 to 18 months. We're very picky here, and there's a good reason for it. We want quality. We want to win. We want to not lose, okay? And when we do lose, like happened in Delia, my last bad pick, we make sure that it's a small position. It was speculative, and if we lose all of our money on that pick, which we don't, generally speaking, we will admit fault at a certain point. In the case of Delia, we admitted fault after a 28% loss in the position, but it was only a 1% position, so our portfolios only lost 0.28%. These are the sorts of things that portfolio management, stock analysis, things like that, that we do on this end. And your job, the methodology for you, it's your instruction manual. We have our own instruction manual on how to pick the stocks, okay? And you have yours. We have our job, you have yours. And this is part of your job, okay? So learn it, stick with it, and as you've seen over the last week or so, when you do, you get the opportunity to buy some of these stocks. GLUU at $350 a week ago. MATR site at $475 a month ago. AERO $275 not too long ago. And each of these stocks are up between 35 and 50% just over the last week, just recouping those downdrafts that people had out of fear, those people that weren't paying attention to the methodology, those people that were selling at lows instead of buying at lows. Okay, taking emotion out of the equation, having faith in the analysis, focusing on the company, its fundamentals, and the last thing that you knew about that company, not worrying, not having fear over what's coming next. Because if you bought the company, you bought it for a reason. Think back to why you bought that company. And hopefully that reason isn't because Mark Gomes said so. Mark Gomes is not a god, okay? I'm not a messiah. I'm just a guy following the same rules that I was taught by people that were taught by great investors, okay? My mentor was taught by Jimmy Rogers. If you don't know that name, look it up. You'll find out. One of the best investors of all time, okay? He taught my mentor, and he taught me to follow those rules that those guys taught me, right? I'm just following an instruction manual. I'm just baking a cake here, okay? From there, you have to decide for yourself whether that cake I baked is tasty or not. And if you think it's tasty today, then you'll think it's tasty tomorrow too. So there's no reason why you should panic just because other people feel like they don't like the cake. Analogies. It's 8:04 p.m. Time to wrap it up. And as I like to say, through ups and downs, through thick and thin, as we've seen over the last few months, Peter here to teach you the lessons that made Warren Buffett a billionaire, Peter Lynch famous. Stick with us. We'll stick with you and teach you more lessons that will help you make millions, keep your millions, and who knows, one of these days, if you accumulate 1,000 of those millions, you too will be a billionaire like Buffett. Until next time, this is Mark Gomes signing off. Wish you great prosperity. Take care.